Most people think the housing crisis is simply about high mortgage rates, but the reality is much bigger than that. Mortgage rates matter, of course, but they aren't the only reason. Millions of Americans are struggling to buy a home, pay rent, or comfortably retire in the house they've lived in for decades. Behind the scenes, Congress has been working on housing legislation aimed at tackling problems that have been building for years. Limited housing supply, aging infrastructure, restrictive local zoning, and the growing challenge of helping older Americans remain safely in their homes. If you're a homeowner, a renter, someone approaching retirement, or even a parent hoping your children will one day be able to afford a home, today's video directly affects you. Now, before we begin, let's set realistic expectations. No housing bill can magically make homes affordable overnight. It won't suddenly cut every family's mortgage payment, reduce rents across the country next month. Housing markets are influenced by interest rates, local regulations, labor shortages, construction costs, and population growth. Those problems developed over many years, and they'll take time to improve. But that's exactly why this conversation matters. The biggest financial opportunities often come from understanding structural changes before they become obvious to everyone else. When new housing policies encourage more construction, improve financing options, modernize federal housing programs, or expand resources for communities, the effects usually appear gradually, not in headlines, but in everyday life. By the end of this video, you'll understand what Congress is trying to accomplish, who is most likely to benefit, where expectations should remain realistic, and the practical steps homeowners and renters can take right now. Let's start with the biggest issue driving this entire conversation. America simply doesn't have enough homes. For years, economists, builders, and housing experts have pointed to the same underlying problem. The United States has built fewer homes than population growth has demanded. The result is straightforward economics. When demand grows faster than supply, prices increase. That's exactly what many communities have experienced. In some areas, young families find themselves competing against dozens of other buyers for the same property. In others, renters face steadily increasing monthly payments because apartment vacancies remain limited. And for many retirees, the problem looks different but feels just as serious. They've spent decades building equity in their homes, yet when they decide it's time to downsize, they discover there aren't many affordable smaller homes available nearby. That's one of the reasons recent federal housing reforms have focused less on creating a single, nationwide solution and more on removing barriers that make it difficult to build different kinds of housing. Instead of concentrating only on large suburban developments, policymakers have increasingly looked at smaller housing options that fit changing family needs. Think about the neighborhood where you live. Maybe there are large single-family homes built 40 or 50 years ago. Many of those homes are now occupied by one or two retirees after their children moved away. At the same time, younger families are searching for starter homes that barely exist. One of the ideas gaining support is encouraging communities to allow a greater variety of housing, including accessory dwelling units, duplexes, townhomes, modular construction, and manufactured housing where appropriate. These options aren't meant to replace traditional neighborhoods. They're meant to create more choices. For a retired couple, that might mean moving into a smaller home closer to healthcare while remaining in the same community. Recent federal housing discussions have included ways to strengthen oversight of federally assisted housing, improve accountability, preserve affordable rental units, and modernize programs that help lower-income households access safe housing. Notice something important. The goal isn't simply creating more regulations. The goal is improving stability. Housing stability matters because it affects nearly every other part of a family's financial life. When housing costs become unpredictable, budgeting becomes more difficult. Emergency savings disappear faster. Retirement contributions often get postponed. Debt grows. Financial stress increases. Housing isn't just another monthly bill. For most households, it's the largest expense they have. That's why even relatively small improvements in housing affordability can create meaningful, long-term financial benefits. Here's where many people misunderstand how legislation works. Passing a law is only one step. Implementation comes afterward. Some programs require federal agencies to publish guidance. Others require states or local governments to participate. Some create pilot projects before expanding nationally. Others simply authorize funding that Congress must continue supporting through future appropriations. This is where expectations matter. If you hear someone claim that a housing bill means everyone will suddenly receive grant money or every neighborhood will immediately see lower home prices, be cautious. Real housing reform usually works slowly, and ironically, that's often a sign of good policy. Large structural changes require coordination between federal agencies, state governments, cities, builders, lenders, nonprofit organizations, and private investors. That takes time. Now let's talk about something almost nobody discusses when housing policy is in the news. The difference between supply and affordability. They're connected, but they're not identical. Imagine a city builds 10,000 luxury apartments. For an adult child, it could mean building a small accessory dwelling unit for an aging parent. For a young family, it may simply mean having more entry-level homes available instead of competing for a shrinking inventory. Here's what often gets overlooked. Housing isn't only about buying, it's also about staying. Millions of older Americans would prefer to remain in the homes they've owned for years. The challenge isn't emotional, it's practical. Maybe the stairs have become difficult, maybe the bathroom no longer feels safe, maybe rising maintenance costs have become overwhelming. Federal housing policy has increasingly recognized that aging in place can be both financially efficient and personally beneficial, supporting home modifications, improving accessibility, and helping local communities preserve existing housing stock can often cost less than forcing families into more expensive alternatives later. That doesn't mean every homeowner automatically qualifies for assistance. Many programs depend on income, location, and local implementation. But the broader direction is important. Instead of viewing housing only as construction, policymakers are increasingly viewing housing as preservation. Keeping safe housing available can be just as valuable as building new homes. Now let's talk about renters. This is where many Americans have experienced some of the biggest financial pressures. Over the past several years, rent increases have outpaced income growth in many cities. At the same time, many rental properties have changed ownership. Large investment groups have entered parts of the housing market that were once dominated by individual landlords. For some renters, nothing changed. For others, maintenance became slower, communication became more complicated, and lease terms became increasingly standardized across large portfolios. Technically, housing supply increased, but if the average retired household can't afford those apartments, affordability hasn't improved very much for them. That's why many housing experts argue that increasing supply needs to happen across multiple price points: starter homes, workforce housing, senior housing, affordable rental units, manufactured housing, adaptive reuse of commercial buildings. Each serves a different part of the market. A balanced housing system requires all of them. This is also why some federal housing initiatives emphasize reducing unnecessary construction barriers rather than simply spending more money. If it becomes easier to finance, approve, and build appropriately priced housing, the private sector has more incentive to increase supply. That's not a quick fix, but over time, increased supply can reduce the pressure that pushes prices higher. Here's the part almost no one talks about. Many families focus entirely on mortgage rates while ignoring total housing costs. A slightly lower mortgage rate doesn't help much if insurance premiums double. Lower monthly payments don't solve the problem if maintenance costs keep rising. Likewise, homeowners sometimes delay necessary repairs because they're trying to save money today. Unfortunately, small maintenance issues often become much larger expenses later. A leaking roof becomes water damage. A loose handrail becomes a fall risk. Poor insulation becomes years of unnecessarily high utility bills. Financial planning isn't only about growing wealth. It's also about protecting the assets you already have. For many retirees, their home represents the largest asset they'll ever own. Protecting that investment often begins with regular maintenance rather than major renovations. Now think about two households. The first reacts to headlines. Whenever they hear news about housing, they assume either everything is getting worse or everything is suddenly fixed. They make decisions emotionally. The second household pays attention to long-term trends. They understand that housing markets move gradually. They review their finances regularly. They compare insurance costs. They understand local property tax rules. They explore available housing counseling resources. They make decisions based on information instead of emotion. 5 years later, those two households often find themselves in very different financial positions. Not because one earned dramatically more income, but because one consistently made informed decisions while the other reacted to headlines. Picking up where we left off, let's bring this closer to home. If you're in your 30s and trying to buy your first home, the biggest takeaway isn't that homes are suddenly going to become cheap. It's that over the next several years, you may begin to see more housing choices than you've had in the past, more townhomes, more smaller, single-family homes, more manufactured and modular housing developments, more communities experimenting with different zoning rules. Those changes won't happen everywhere at the same pace, but even modest increases in supply can reduce some of the intense competition buyers have experienced in recent years. If you're in your 40s or 50s, this law matters differently. Many people in this age group are caring for aging parents, while also helping adult children who are struggling with housing costs. It's become known as the sandwich generation, and housing pressures often hit both directions at once. That's why some of the policy focus on accessory dwelling units, home preservation, and flexible housing options is significant. Families increasingly need housing that adapts to changing life stages instead of forcing expensive moves every few years. And if you're approaching retirement, perhaps in your early 60s, this may be the right time to think less about the value of your house and more about whether it will continue supporting the lifestyle you want over the next 20 years. A large home with multiple stories may have been perfect while raising a family. That doesn't necessarily make it the right home for retirement. This is where many households get caught. They spend years planning for retirement income, but very little time planning for retirement. Housing isn't just an investment. It's a monthly expense. It's property taxes, insurance, maintenance, utilities, accessibility, transportation, healthcare access, neighborhood safety. All of those factors become increasingly important as people age. Sometimes staying in the same home is absolutely the best financial decision. Other times, downsizing earlier, before maintenance becomes overwhelming, can strengthen long-term financial security. Neither answer is automatically correct. The important thing is making the decision intentionally, instead of waiting until circumstances force it. Another area receiving increased attention is housing counseling. Many people hear the words housing counselor and assume they're only for someone facing foreclosure. That's no longer the case. HUD-approved housing counselors can help people understand mortgage options, refinancing decisions, reverse mortgages, budgeting, homeownership education, foreclosure, prevention, and rental issues. For first-time buyers, this guidance can help avoid costly mistakes. For retirees, it can provide an objective look at whether aging in place, downsizing, or relocating makes the most financial sense. The value isn't simply information, it's perspective. Buying or selling a home is one of the largest financial decisions most families ever make. Having an experienced professional explain the options can reduce expensive mistakes. Small improvements accumulate, more housing options appear, communities become more flexible, investment follows opportunity. Over time, those individual decisions create broader market change. So what should you actually do this week? First, take an honest look at your housing costs as a percentage of your monthly income, not just your mortgage or rent, but insurance, taxes, utilities, maintenance, and transportation combined. Understanding your true housing expense gives you a clearer picture of your overall financial health. Second, if you're considering buying or selling within the next few years, spend time learning about your local market rather than relying on national headlines. National averages rarely reflect neighborhood realities. Third, if retirement is approaching, ask yourself an important question. Will your current home support the lifestyle you want 10 years from now? Thinking ahead gives you more choices than waiting until a major repair or health issue forces a decision. Fourth, explore the resources available through HUD-approved housing counselors and direct local housing agencies. Even if you don't need assistance today, understanding your options can help you make better decisions tomorrow. And finally, remember that housing is only one part of your overall financial plan. Protecting your savings, managing debt wisely, investing consistently, and preparing for retirement remain just as important. No single law creates financial security. Good decisions repeated over many years do. That's really the larger lesson behind today's discussion. It's easy to become distracted by dramatic headlines predicting either disaster or miracle solutions. Now let's talk about something that's quietly changing beneath the surface. Technology. Housing construction today looks very different than it did 20 years ago. Factory-built modular housing has improved dramatically. Manufactured homes built under modern federal standards are very different from the outdated image many people still have. Digital permitting systems are helping some communities approve projects faster. New construction techniques are reducing waste and improving efficiency. These changes don't receive the same attention as mortgage rates, but over time, they can influence housing affordability by reducing construction delays and lowering development costs. Again, none of this guarantees lower prices everywhere. Real estate remains intensely local. A growing suburb in Texas will behave differently than a small town in Ohio. A coastal city in California faces different challenges than a rural community in Iowa. That's why one national headline rarely tells the whole story. Local supply, local employment, local zoning, local population growth. Those factors continue shaping housing markets alongside federal policy. Here's another mistake households often make. They assume the best time to prepare is after the market changes. In reality, preparation usually starts long before. If you're thinking about buying within the next 3 years, begin improving your credit profile. Now, review your debt-to-income ratio, build emergency savings, research first-time homebuyer programs offered by your state or local housing agency. Understand what monthly payment truly fits your budget, not just what a lender is willing to approve. If you're already a homeowner, review your insurance coverage every year. Understand your property tax assessments. Create a maintenance fund dedicated to future repairs. Many financial advisors recommend setting aside money annually for expected maintenance, rather than waiting for expensive surprises. If you're renting, know your lease. Understand your state's tenant protections. Document maintenance requests. Keep copies of important communications. Knowledge often becomes your strongest financial protection. One of the most encouraging aspects of current housing policy discussions is that lawmakers across the political spectrum increasingly agree on one basic reality. America needs more housing. There may be disagreements about how to achieve that goal. Some emphasize deregulation, others prioritize public investment. Some focus on tax incentives, others encourage local zoning reform. But there's growing recognition that expanding housing opportunities benefits homeowners, renters, employers, retirees, and future generations alike. That broad agreement is important because housing challenges rarely disappear after one election cycle. Meaningful improvements require years of consistent effort. For homeowners wondering whether this legislation will immediately increase their property value, The honest answer is probably not. Home prices depend on many variables: interest rates, local employment, inventory, consumer confidence, regional demand. Federal legislation is only one piece of a much larger puzzle. For renters hoping this law will dramatically lower monthly payments next year, expectations should also remain realistic. Increasing supply takes time. New construction takes time. Infrastructure improvements take time. Policy implementation takes time. But slow progress should not be confused with no progress. Many of the strongest economic changes happen gradually enough that people barely notice them while they're occurring. Think about the neighborhoods that transformed over the last decade. Those changes didn't happen in a single month. They happened one building, one renovation, one new business, and one family at a time. Housing reform often works exactly the same way. The reality is usually much quieter. Successful households rarely build wealth by reacting emotionally to every news cycle. They pay attention to long-term trends, they stay informed, they adapt when necessary, and they make thoughtful decisions based on facts instead of fear. The recent federal housing reforms represent another step in an ongoing effort to improve America's housing system. Some parts may prove highly successful. Others may require adjustments over time. That's how public policy often works. The important thing is understanding what changed, recognizing how it might affect your own financial situation, and making decisions that position your household for long-term stability. I'd love to hear your perspective. Are housing costs in your community getting better, staying the same, or becoming more difficult? If you're a homeowner, what's been your biggest financial challenge over the past few years? And if you're renting, what change would make the biggest difference for you? Share your thoughts in the comments below. I read as many as I can, and they often inspire future videos. If you found today's breakdown helpful and want more straightforward explanations of the financial changes affecting homeowners, retirees, Social Security, taxes, and the economy, consider subscribing. My goal is simple: cut through the headlines, explain what actually matters, and help you make smarter financial decisions with confidence. Thank you for watching, and I'll see you in the next video.